Welcome to the deep dive. We sift through stacks of research, reports, all the strategic notes, really, to bring you the critical insights. Today, we're doing a deep dive into Baker Hughes, ticker's BKR. They're a major player in energy technology, right at that tricky intersection, balancing global energy needs with the shift to cleaner stuff. Our analysis is based on a share price of $46.69 as of October 28th, 2025.
Exactly. And our goal today really is to figure out if VKR is actually pulling off this big strategic pivot they've been talking about. The key question, the hook for this whole thing is, can Baker Hughes genuinely shift from its, let's call it, oil field past to really capitalize on this age of gas and, well, new energy tech? The data we've looked at suggests, yeah, there's a potential discount here. Maybe the stock's worth closer to $60, but
Yeah.
the market clearly isn't fully convinced yet. Execution risk seems to be the big hang-up.
Right. So let's dig into why there's that gap. Let's start with Chapter 1, Business Understanding. So BKR is trying to solve what some analysts call the energy trilemma.
Yeah, that's the constant juggling act for energy companies worldwide, isn't it? How do you keep energy secure, affordable, and sustainable all at the same time? BKR's approach is kind of a two-pronged strategy. They've got the traditional oil field services and equipment segment, the Alethis bit. They're running that basically as a cash machine, reliable cash flow.
Okay, the cash engine.
Exactly. And then they're pouring investment and focus into the industrial and energy technology segment, or IET, that's positioned as their, high-quality, high-growth engine for the future.
And that IET part, that's where the competitive advantage, the moat, really comes in, right? It's
Yeah.
heavy on turbo machinery, gas turbines, compressors, things needed for LNG and power generation. How does having that equipment out there help their revenue?
Oh, it's fundamental. It really changes the game for them. Think about it. Once a company builds an LNG plant or a power facility using BKR's turbines, those things run for, 20, maybe 30 years?
A long time.
A very long time. And you're essentially locked in. Switching out that core equipment is incredibly expensive and disruptive. So BKR gets this steady stream of high-margin, recurring revenue from servicing, parts, upgrades. It's much more stable.
Which is exactly what they need to balance out the ups and downs of the traditional oil field services side.
Precisely. It's the counterweight. And this whole strategy relies heavily on a major market trend they call the age of gas. Management's betting big on this, citing forecasts suggesting global LNG demand could jump 75% by 2040.
75%, wow.
It's a huge number. Now, competitively, BKR is solid. They're one of the big three in oilfield services, alongside SLB and Halliburton. And getting into that league, it's tough.
High barriers to entry.
Extremely high. You need massive capital, decades of proprietary tech development, global scale. Smaller companies just can't really compete at that level. BTR's position is pretty well protected there.
Okay, let's shift gears and talk about leadership. Let's move into Chapter 2, Management Evaluation, Stewardship, and Strategy.
All right, so the CEO, Lorenzo Simonelli, he's been central to this whole shift. He managed the tricky integration of GE Oil and Gas a while back, and now he's driving this pivot. And you have to give them credit operationally. I mean, look at the track record. They've hit or beaten their EBITDA guidance for 10 straight quarters, at least as of Q2 2025. That tells you something about their execution and, frankly, management's credibility.
Okay, but that credibility is really being put to the test now with their M&A strategy, isn't it? They're making some big moves. The research highlights this pending deal. $13.6 billion to acquire Chart Industries. That's enormous. I mean, $13.6 billion. Isn't that a colossal risk, especially for a company still trying to prove it's not just a cyclical oil play? How does that square with the idea of a fortress balance sheet?
That's absolutely the core question, the big gamble.
Yeah.
Management is clearly betting the strategic fit is worth the near-term leverage increase. Chart is all about LNG, hydrogen, and clean energy tech. It directly beefs up that crucial IET segment. But to your point about risk, they have been trying to manage it. They've been selling off other less strategic assets. Remember the PSI product line sale? That brought in over $1 billion. It's like they're selling off parts of the old house to fund the big new expansion.
Selling the old to buy the future. And that focus also seems to shape how they handle returning cash to shareholders. They've got a dividend. It's growing, just raised to $0.23 a share, right? About 9.5% growth year over year. But they hit pause on the share buybacks, a $4 billion program.
Yeah, and that pause, I think, needs context. It looks like classic capital discipline, actually. Not a sign of weakness, more like a deliberate choice. They're holding on to cash specifically to make sure they can comfortably close and integrate this massive Chart deal. Management seems to view getting that acquisition right as a higher priority, a better use of capital right now than buying back shares in the short term.
And the payoff, if they get it right, is showing up in their return on invested capital, the ROIC.
Absolutely. The ROIC metric really tells the turnaround story quite powerfully. I mean, it was negative back in the downturns of 2020, 2022, but it's bounced back strongly. The trailing 12 months, or TTM, figure is now 11.3%.
And TTM, just to clarify for everyone, that's just looking at the last 12 months of performance.
Exactly. So that 11.3% ROIC confirms that this strategic shift towards higher margin technology, towards IET, it's actually delivering better quality returns on the money they're investing. It's not just talk.
Okay, let's get deeper into those numbers. Time for Chapter 3, Financial Analysis, a quantitative deep dive.
Yeah, the recovery is pretty clear when you look at the top line. Revenue bounced back nicely. It went from about $21 billion in 2022 to nearly $28 billion TTM as of Q3 2025. But honestly, the margins are the really important story here. TTM gross margin is up to 21.4%. That's a big jump from like 16.6% back in 2020. And the operating margin, TTM, is now 12.8%. This expansion is solid proof the IET strategy is bearing fruit financially.
And you mentioned before, it's worth looking past the standard net income number sometimes.
Definitely. GAAP net income, the accounting profit, it was all over the place, even negative in 2020. But free cash flow, that's the actual cash the business generates after investments, the stuff that pays dividends, that's been strong and growing consistently, hit about $2.26 billion in 2024. That FCF is what gives them the firepower for big strategic moves like buying Chart.
And underpinning all this, especially with that big acquisition looming, is the balance sheet health.
Yeah, we touched on it, but it's worth emphasizing. It's genuinely strong. Their debt-to-equity ratio is down to just 0.33, which is incredibly conservative, especially when you think it was over 40% just 5 years ago. They've worked hard on that.
Wow, that's a significant drop.
It is. And their short-term liquidity looks good, too. The current ratio is 1.41. So financially, they seem well prepared, even heading into a huge deal like Chart.
And valuation. The current PE ratio is sitting around 16.1x on a TTM basis.
Yeah, 16.1x. That looks pretty attractive, doesn't it? Especially when you compare it to the 5-year average, which was way up near 42x. But that older number was skewed by those periods of really low earnings. So 16 times current, healthier earnings. It does suggest the stock might be, pretty reasonably priced, maybe even cheap, given the improvements.
Okay, we're about halfway through our deep dive here. If you're finding this breakdown valuable, please do hit like and subscribe over on the Stock Analytics AI YouTube channel. It really helps us out. And remember, for just $4.99 a month, members get access to our full playlist. That's 500 deep dive videos covering the entire S&P 500. Plus, we're launching NASDAQ 100 coverage soon, exclusively for members. And hey, if there's a stock you want us to analyze, members can just drop the ticker in the comments and we'll add it to our list. All right, let's shift perspective now. Let's look outside the company. Time for Chapter 4, Market Sentiment, the Wall Street Narrative.
Okay, so Wall Street.
Yeah.
The general consensus among analysts is a moderate buy. Not a screaming buy, but positive. The average price target for the next 12 months falls somewhere between $51.32 and $52.89.
Which, from today's price, implies maybe 10% to 13% upside.
Right, pretty modest upside.
So here's the puzzle, right? If the underlying business looks strong, improving margins, good ROIC, solid FCF, the strategic pivot seems to be working. Why are the analyst targets relatively, tame? Why aren't they higher, closer to that intrinsic value you mentioned earlier?
Yeah, this is that disconnect we talked about at the start. Our own discounted cash flow modeling points towards an intrinsic value, maybe closer to $61.44 share. The gap exists, I think, because the market and analysts are often slow to change their perception of big established companies. They still largely see BKR through the lens of its cyclical oilfield services past. They haven't fully bought into the transformation into a more stable, higher growth industrial technology company. It's just what the IET segment represents. That kind of narrative shift, that re-rating, it just takes time.
Makes sense. And technically, the stock itself looks pretty healthy.
Technically, yeah. It's showing a solid long-term uptrend, trading comfortably above its 200-day moving average, which is hovering around the $41.75 to $42.50 mark. And there's not much negative betting against it either. Short interest is quite low, around 2.1% and 2.4%.
Okay, good context. Now let's look at who actually owns the stock. Let's move to Chapter 5, Ownership Structure. Who holds the reins?
Well, the ownership picture is pretty clear. It's dominated by institutions. We're talking about 98.7% institutional ownership. Huge. And the names at the top are the usual suspects: Vanguard, BlackRock, JP Morgan. These are typically very large, stable, long-term holders. Their presence suggests they buy into management's long-term strategic vision. They're patient capital.
But, and here's the conflicting data point, Contrast that massive institutional backing with the insiders. Management and directors own a tiny fraction, just 0.14%. And look at the recent trading activity, 44 sell transactions versus only 6 buys in the last year. That's a net sale of over 759,000 shares. If the stock is really undervalued, potentially worth $61, why are the insiders, the people who know the company best, selling more than they're buying? What does that tell us?
It's a really important question, and you have to be careful how you interpret it. On one hand, a lot of insider selling can be routine. Executives diversifying, exercising options via preset plans, 10b5-1 plans. But the ratio here, 44 sells to 6 buys, is pretty stark. It does raise an eyebrow. Perhaps it suggests that management, while confident long-term, doesn't see a huge immediate upside surge coming. Their view might align more with the patient institutions. This is a multi-year story, heavily dependent on successfully integrating chart. They might feel the current price is fair for now, and the real value unlock is still some way off. They aren't rushing to load up personally just yet.
Interesting perspective. Okay, let's broaden the view again and assess the potential bumps in the road and also the opportunities ahead. Let's go to Chapter 6, Risk Assessment. Identifying headwinds and tailwinds.
Okay, risks and opportunities. Let's start with the good stuff, the tailwinds, the opportunities. The biggest one is obviously that whole age of gas trend, the secular growth in LNG demand we discussed. That's huge for IET. But there's another interesting customer base emerging. Data centers. Their growth is explosive, and they need massive amounts of reliable power. That's a perfect fit for BKR's IET offerings, especially turbines. And then you have the whole new energy space, carbon capture, CCUS, hydrogen, where BKR is trying to establish leadership. That's a longer term, but potentially massive opportunity.
Right. And on the flip side, what are the major headwinds, the risks they can't really avoid?
Well, number one is still that inherent cyclicality. Even with the IET segment providing a buffer, their office business is still tied to the roller coaster of oil and gas prices. A deep, prolonged downturn in energy prices will impact their cash flow generation, no way around it. Then there are external risks. Geopolitics is always a factor in energy. The research specifically flagged the risk of potential new U.S. tariffs, maybe 15–20%, that could seriously mess with their global supply chains and push up costs.
And what about those new energy bets like CCUS and hydrogen? Is there a risk there too?
Oh, absolutely. That's a big one. The success and profitability of those ventures are heavily dependent on things outside BKR's control. We're talking government subsidies, favorable regulations, consistent policy support. If governments change course or funding dries up, the economics of CCUS and hydrogen could change dramatically. It's a bet on technology and on supportive politics sticking around.
Okay, that's a balanced view. So let's bring it all together now. Time for Chapter 7. Conclusion. The investment thesis. Can you summarize the core bull case for us?
Sure, the bull case really stands on 4 legs. 1, the strategic pivot to IET is working, shifting the company towards higher margin, more stable revenues. 2, they have a rock-solid balance sheet, low debt, strong free cash flow, giving them financial flexibility. 3, they have a genuine competitive moat, especially in that turbo machinery installed base with its high switching costs. And 4, the market hasn't fully recognized this transformation yet, suggesting the stock is potentially undervalued relative to its improving fundamentals.
And the bear case. What are the main worries?
The bears worry about a few key things. First, that lingering cyclical exposure. They can't escape the oil price cycle completely. Second, execution risk. Integrating that huge $13.6 billion chart acquisition successfully is a major hurdle. It has to go smoothly. And third, that insider selling pattern we discussed. It just tempers short-term enthusiasm a bit, suggesting maybe management isn't seeing imminent massive upside.
So pulling it all together, the analysis suggests the current share price, around $46.69, looks pretty attractive compared to that estimated intrinsic value range, which we pegged between $60 and $62 per share.
That's the conclusion, yes. It looks like a compelling story for investors with a longer time horizon. Patience seems key here. The fundamental business is evolving, maybe faster than the market narrative is catching up. That gap between the current price and the potential intrinsic value likely won't close overnight.
Which brings us to our final thought, something for you, our listener, to think about. We see this strong ROIC trend. We see this aggressive M&A with Chart. If Baker Hughes does execute that Chart integration successfully, how quickly could the market be forced to reevaluate, to finally re-rate the stock as the technology leader it aims to be? And what might it take for those insiders to finally start becoming net buyers again? Lots to consider there. And if you want more deep dives like this one, covering hundreds of stocks, remember to check out the member benefits on the Stock Analytics AI YouTube channel. Access the S&P 500 playlist, get ready for the NASDAQ 100, and tell us which stocks you want covered next.
In just the standard but important disclaimer, this analysis was generated by an AI system. It's intended for educational and informational purposes only. It is definitely not financial advice. Please always do your own thorough research or consult with a qualified financial advisor before making any investment decisions.